Thank you, Zoom lady, for letting us know that this webinar is being recorded. Yes, we are recording the webinar today. So if for some reason you wanted to watch it again, or for some of you who missed it, you can definitely go and watch this recording. Give about maybe 1 minute or so for the rest of everyone to jump in and get connected to the webinar. And while we're doing that, I do want to let you know we're not planning on spending too much time on the webinar tonight. It's not like our typical kind of a deal announcement webinar like that, where we spend, usually about, 45 minutes to an hour going over to a lot of the different nuances and specifics of a deal. This particular one is going to go over very specifically about this lease audit, and then also giving you an update on our on-site due diligence and some things that we have discovered and found, which I think will be good for you to be able to understand how we're doing things here. And then also kind of to kind of reiterate a few things as to why we're still really excited about this acquisition. So let's go ahead and get started here. So I'm Dan Hanford. I'm one of the managing partners here at passiveinvesting.com. And I wanted to share with you a few reasons why we are really excited about this offering still. So first off, this submarket within Orlando is a phenomenal submarket. It's hard to really describe how great this market is. And I knew before we even got this deal under contract that this submarket in Orlando was a great, solid submarket, lots of population growth, over 20% annual since 2010 to 2020. So lots of good things happened in this market. But until I actually went and visited this particular market, I didn't really realize how good it was. You see cranes up all over the place. There's a new high school being built across the street, new single family development. There's a brand new hospital down the road, and just very close to the main kind of corridor, if you will, that going in between, called the 429 going into Orlando. It gives our residents easy access to everything that Orlando has to offer. So there's a lot of great things about the market that we like. And then the second thing I wanted to bring up is really the kind of organic rent growth that we have available on this property, because we're buying it from a merchant builder. And a merchant builder, if you don't know who that is, that's somebody who has a property that they develop, they lease it up as fast as they can, and they sell it as fast as they can. So they're not trying to maximize rents. And this particular property was starting to lease up in March of 2020, which is right at the very beginning of the pandemic. But even throughout the pandemic, they continued to provide 30 plus new leases on this property every single month, right? And so we're actually going to be able to take over this property and have about a 15 to 18% delta on the current effective in-place rents and what the market will actually support and bear. And so even right now, we've already been seeing from from our lease study that there are residents right now that are renewing that are over 10% already proving our business plan, our business model on this. So we're very, very confident with it. So with that, let me turn it over to Brandon and have him go over some of the due diligence that we have found. And then we'll have Danny go over the lease audit here as well.
Thanks, Dan. And of course, for everybody that may be new or just checking in, I'm Brandon Abbott, one of the managing partners at passiveinvesting.com. And this last Friday, we did a roll-up meeting of all our due diligence, all of our on-site due diligence. So when we get a property under contract, we send an army really into the property to make sure that every stone is turned over. We make sure there's no issues with the property. Of course, we didn't expect anything to be the case with a brand new property, really just, under a year old, built by a nationally recognized home builder, so they are well knowledgeable in the space. But we still have to do our part to make sure that every I is dotted, every T is crossed, make sure all the lease audits are correct. So we not only have our property management company go in, who has 4 teams on site, but we also have our own team there making sure that they're checking everything and managing the manager, right? Actually, they're on site. So we had, our asset manager there, we had our acquisitions team there, and we had all of our property management team there as well. So like I said, we just invaded Orlando and this property and just went through every single file, and really great results that we found from that, which Danny's going to go over some of that in a little more detail in a minute. But the overall report from FCA, who's managing this property for us, it was that their inspection of the property, and I'm reading this from the report, revealed that the units are in overall great condition with lease files and are in good condition with some minor discrepancies. There's always some minor discrepancies with deposits and, at $5 off here, $5 off there. But, there was no issues with, letting people in with, maybe some criminal backgrounds or not sufficient credit or not sufficient income. So those are all good things. They're just very minor discrepancies, such as like there was a pet there and they weren't paying pet rent. So that was a good thing. That's going to boost our revenue, because there's multiple people that we found there that were not paying pet rent. So those are good discrepancies. And then the property's physical appearance is in excellent condition. They went through every single lease, every single file, and their summary was that the amenities on the property are far and above that of the surrounding property, and that's straight from our third party property management company FCA's report. So they're submitting this to us. But again, our team is on site, double checking, making sure everything's well. So nothing out of the ordinary here. Very pleased with the results. Actually, it's above normal results for this type of property. We always find some sort of issue or some sort of discrepancy that we have to come up with. There's always going to be the minor thing. I think we found an extension cord that was run across the pool from the pump to another section that looked like they had a little bit of issue there. And then there's, I think in one or two of the units, there was a little piece of vinyl flooring that was curled up a little bit on the corner. I think there's a little bit of drywall, like a poor drywall job in the ceiling in one unit. So out of this many units, to find very few things is phenomenal. And the great part is it's all covered under warranty. So we've already compiled the list of the minor things that we found, and the seller is going to cover under their warranty because they are the builder, the contractor, they are the seller. And so they'll take care of all those things. And once we take over the property, those things are continued to be under warranty as well. So, landscaping is under warranty. So if we have some plants die or different things like that, there's a period of warranty under that. So that should give some comfort there that if we, let's say we, by some minor chance, miss something on our very detailed inspection, it's still going to be covered under warranty. So that's the gist of it. Overall, great inspection, nothing out of the ordinary, and very excited to continue to close on this deal for you. And I'll hand it back over to Danny, and he can go over some of the demographics.
Yeah, Brandon, just to confirm, the extension cord that needs to be corrected, that was in a landscape bed, right?
Yeah, it was run across the landscape bed, but it went from the pool
for
pump.
a pool pump or something like
Yeah.
that.
There's some sort of an issue there. So, one of those things, the maintenance man wanted to get it working real quick. And so let's just make it work. And they just, no permanent fix. So that, if that's all we come up with, we're in good shape.
Yeah, exactly. Well, again, one of the most important steps from an underwriting perspective, this is probably my favorite slide and data point as we think about investment opportunities from the highest level, right? We talk about how there is diverse economic indicators in the market, both from a population and population growth perspective, as well as from an employment demographic perspective. So we like going after properties in this Orlando market because there is a diversification of employers. If one thing or industry or employer goes away, we're not at a significant risk to keeping the property occupied with residents that have jobs and can pay the bills. And so we've got a very good diverse mix here of different employer types and backgrounds. Corporate is our largest, and it's the highest income earners, over $100,000. About a quarter of the property is on the corporate employer, and they're making, into the six-figure range, which is excellent. Travel and entertainment, this is an area that certainly we looked into, being that travel and entertainment did get hit during COVID. However, these types of jobs with the average income being north of $70,000 a year, our residents are probably into middle management or upper management at a travel or entertainment company. So we had seen this in some of our properties in Raleigh in the RTP area, where folks did work for travel or entertainment companies, or even in Charlotte with NASCAR. But our residents, again, being these higher income earners, that 70,000 and up, are in a a great type of job within that industry, and they're able to keep their job, work throughout COVID. And so, while we have about 16% of the property in this travel and entertainment um, industry, we feel very strongly that these are good jobs, highly qualified individuals as well. Medical, government, military, teacher, self-employed, retired, a great another mix to kind of round out some of that property. Now, one of the most important things that I always look at from a not only a diverse economic employer mix, but what is our average income at the property? And so the overall average income is just over $81,000 a year. And I always look at our math and make sure that the numbers make sense. Our average income, or excuse me, our average rent at the property is about $1,600 a month in monthly rent. And the rule of thumb to qualify for an apartment is 3 times your rental rate for monthly income. So $1,600 times 3 is about $4,800 a month that someone is required to make. Extrapolate that over 12 months, and you're looking at an average income of $57,600. And so every employment category that we have here on this list is above $57,600. And our average income is roughly 30% higher than actually, it's even higher than that. Is it 60% above the 57,600? And so it gives us a great level of confidence in the population that's surrounding this property, as well as the diverse economic employers and the salaries that the residents are actually making. So again, this is really what we expected to see based on this level of property, the new type of property that is there, and again, the great employers that all surround where our residents work. So really pleased with the findings, and I think we've got ourselves a great conservative investment opportunity where, again, we're going to have a lot of folks that want to live here. We're going to have some highly qualified residents, and we're going to be able to keep our occupancy up.
Awesome. And if those of you who have joined us live, if you have any questions, you can certainly type them into the chat box. Obviously, this type of an update is not necessarily going to spark too many questions, but if for some reason you have a question, you want to type it in, feel free to do that, and we'll answer as many of those as we can. If for some reason we don't get to your question, or maybe you're watching the recording of this webinar, you can certainly reach out to each one of us individually. We would be more than happy to answer any questions that you have. We always try to be as accessible and available to our investors as much as we can. So we do have a question here that has come in from Brian, and I'll bring this over to you, Danny. Is there a big spread between the average and the median income?
The average, when we're looking at these, when we're looking at multifamily properties, the average is always the better number to use. The median income is typically a lot higher than the average because we may have some outlier folks who are higher income earners. And so you may have a self-employed or a retired person that might be making, north of $250,000 living in an apartment. So the average is really the best ratio to use. And the median, it's a small subset. So we always prefer to use just the average.
Yep. Brandon, this will be one I'm going to turn over to you. So who will be the target buyers at exit on this property?
Yeah, so this is definitely an institutional sale. A property this size, this is a common business strategy, is to get an asset of this size, of this quality, of this, it's nice and new, and run it for 5 years, stabilize it, increase rents, and then sell it it's going to be more like a REIT, a publicly traded REIT, or a large 1031 group or a DST group. So somebody that plays in the large space to be able to take this down. We definitely wouldn't be deal with. It's not going to be a buyer we're going to have trouble qualifying. People that are going to be looking at this are going to be the institutional style.
Yep. There's another question here coming from how are self-employed applicants qualified? Is it all done with a 2 to 3 years tax returns ? And I'll answer this one. So it really depends on the self-employed applicant, right? So they have to be able to prove their income in some form or fashion. So whether that means that self-employed person has themselves on payroll and they can provide, payroll statements that shows they're getting paid, or they can provide bank statements or tax returns. We do try to look at as many of those as possible to make sure that they are qualified to be a resident on the property, and that's what we have to do in order to maintain the integrity of the resident demographic on the property and make sure that we're not getting too many people on the property that cannot actually afford the property as well. All right, so I'll turn this one over to Brandon as well. What is the status of new units and permits for multifamily in the properties area?
There is some supply, it's pretty close to us, but the demand far exceeds that. There's a property right next door to this one that's currently leasing up, and it has not affected the lease ups at this property, nor has it affected the ability to increase rents on our property. And that's right, literally across the street. The great thing about Ascend Waterleigh is it's very hemmed in that you can't put any more multifamily right directly around it, because we have the highway, the 429 that runs on one side. We have Disney owned property that is designated to be retail. It's not large enough to be like a park or anything like that. And Disney does not do employee housing and different things. So that's a good, and there's a green area, and then there's some of the water infrastructure, the drainage infrastructure on the other side. And then there is another parcel owned by DHI or DR Horton that is adjacent. But overall, the market population growth far exceeds the supply that is scheduled, that is in the pipeline.
Yeah, I would just mention and reiterate that conservation easement area as well, that, because it's classified as that conservation easement, nobody can build on it. So it's great to kind of have this kind of landlocked, if you will, and not have to have the fear of, too many multifamily units coming in and creating an oversupply of this particular market. But just like Brandon said, there's a lot of new population growth that's happening in this particular area, and it's only going to get even better, right? That's one of the main reasons why there's so many different type of developments that are happening in this particular market, to be able to support and put in the infrastructure in place to support all the new residents that are actually moving into this area. Mm-hmm. Well, it doesn't look like we have any other questions that have come in, so I will go ahead and close things up. Thank you, gentlemen, for jumping on here and sharing the information about the Ascend Waterleigh acquisition. We're all three still excited about it. Looking forward to taking this over. To give you a little bit of an update on this one, the funding deadline is later this week on Friday, so make sure you do get your funds in. We do have a large majority of them already in, and we are close to about 90% subscribed on it. So if you want to increase your commitment, or if you want to submit your soft reserve, go ahead and do that now, so we can go ahead and finish up the rest of this. And then for those of you who have been asking about the closing timeline on this one, it did get pushed to the week of July 5th. And that was primarily due to some sellers council kind of dragging their feet a little bit on getting the PSA signed. So there's a little bit of a delay there. But the updated kind of target time frame for closing is the week of July 5th. So if for some reason you have some issues getting funding in this week, just let us know. Give us an update on when you can get those funds in. We can be flexible there. But we do like to try to have those funds in about 3 to 4 weeks before closing, so that we're not all scrambling at the day before close and trying to get funds in. So it's worked really well for us in the past. Looking forward to partnering with you on this acquisition and many more in the future. So hope you have a great rest of your night, and we'll look forward to any questions that you may have later in the week. Thank you.